Welcome to the Alternative Investment Podcast. I'm Andy Hagans, and today we're talking about the work revolution and venture capital investment from the perspective of a GP, from that inside perspective. So I'm very excited that joining me today is Gale Wilkinson, who is managing partner at Vitalize Venture Capital. Gale, welcome to the show.
Hello, Andy. Thanks for having me.
You know, I'm so excited to have you here because it's funny. You guys are great at marketing because I just found Vitalize like clicking around surfing LinkedIn, or I forget how exactly I found it, but I didn't even know. I know you obviously, but I didn't even know it was your fund. And then I was like clicking around and I saw Gale. I was like, wait a minute, I know Gale. That's my Gale. So you guys
Yes, for
are,
the listeners, Andy and I went to school together many years ago. So we have a former life together as friends.
yes, we do. And Gale, I also remember your being involved in angel investing, even like a decade ago. And it's been so cool to just, I kind of meet up with you like every 5 years or whatever. And then the next time I kind of came across it, I was like, wow, she has her own fund. This thing is awesome. So why don't you give us a little bit of your background? Like, how did you come to be running a venture capital fund?
Sure. So I started a couple businesses many years ago. Both of those failed. One of them was when I was in business school. And when I left business school, I wanted to have something that I was running. I had learned over time that I'm definitely a good fit for early stage organizations, and had the opportunity in 2012 to start an angel network that was Irish Angels, which is a group that is affiliated with the University of Notre Dame, which is where Andy and I went to school. And ran that for 9 years. That was a lot of fun. We invested in about 50 companies while I was there and deployed quite a bit of money into all of these companies. Concurrently in 2017, had some of my angels come to me and say, hey, we really want to buy a basket of your stuff. We missed out on a couple of great deals back in 2013. And what do you think about raising a small fund? I hadn't thought about it, but it seemed like a good time to do it. So raised a proof of concept fund that was $16 million in 2018, and deployed that over the following 3 or 4 years.
You say that so casually, like, oh, just, 16 million bucks. But in the venture capital world, that's a pretty small fund, right?
Yes. Most funds are much larger than that.
But, it's interesting because to me, smaller capital, there's like it enables opportunities. Whether you're talking about private equity, venture capital, angel, or whatever, it's like, would running a $1 billion, $200 million fund be fun and interesting and all that? Like, of course, but then there's things that you'd be giving up, right? With not being as nimble. Do you think that's fair?
Yeah, I'm a founder, and so we have a team of 4 full-time and 3 part-time, and that's perfect for somebody like me who likes to move quickly, who likes to empower the rest of the team to do what they do best. Back to, you said you found us on marketing. I decided a couple of years ago to invest in a head of marketing, which is super rare for a small fund like us,
Yeah.
but I really see opportunity here. And Justin has done a great job in terms of building our podcast and our newsletter and our social media presence. And beyond that, to ensure that people really know who we are so that we're seeing the best deals in our space.
And I want to encourage all the fund managers that listen to the show, that watch the show, even if you're not a VC fund manager, even if private equity, private real estate, look at what Vitalize is doing. Because from my perspective, I'm a marketer at heart. I love marketing. But what you all are doing, I mean, I think that's genius because you have a newsletter, you guys blog, you're very active on LinkedIn, you have a huge Twitter following. It's all very engaged. So I imagine by the time an LP or by the time a founder interacts with you, it's like you've built all this trust. Like they already know who you are. They already know what you stand for. It's like they just kind of soak it in. We would call that content marketing if I could use the nerdy marketing term or whatever, but it's branding. And it just, then when you have that meeting with an LP or with a founder or really any kind of meeting, there's just like all this context and trust built up. It's hard for me to imagine that anybody's not doing that in today's day and age, but they're not.
Yeah, it's mostly the larger funds, and they're in venture. There's a long tail of a ton of small funds like us. So I'll call those sub $100 million funds. And the way that VC works, as most of your listeners will know, is based on, an operational budget built on management fees. And the smaller your fund is, then the smaller your operations budget. And that's why it's typically the larger funds that have a surplus in their operations budget to be able to pay for things like marketing and content. And it's a luxury for small funds, but we were able to figure out how to do that at the same time where we were building our angel community. And we see that content and thought leadership, branding, community are all things that others aren't really focusing on, but we see that as a way to differentiate ourselves in the market.
Well, totally. And for the record, larger funds with larger marketing budgets, in my experience, they don't necessarily do it better. Like a lot of the most interesting marketing is the founder or executive team or like the folks sitting in the seats making the decisions. That person, like Gale tweeting in real time or on LinkedIn, like that, to me, that's the interesting content, not someone 3 levels deep in the org chart. I wrote this press release. Now I need 3 different people to sign off on it. I'm like, that was marketing in the 1980s. I think we've all moved on, but I want to talk about your fund specifically though. So speaking of marketing, I think it's so important for a fund to have a thesis. You talked about the long tail and venture capital. By the way, a ton of our audience will not be that familiar with venture capital because, a lot of VC, has a more institutional capital base. And a lot of our listenership are individual high net worth investors. But in that marketplace of the long tail, there's so many funds with private equity, venture capital. You have to differentiate, and your fund is just so focused. Like I go to your website, the theme is clearly the future of work. The tagline that I actually wrote down, investing in the work revolution. I love that. I'm a marketing guy. Like I land on a homepage like that and I'm like, okay, you piqued my curiosity. But I think a lot of our audience has heard those phrases, the future of work and all that. But I want to know what that means in your view, because I think I've kind of heard a couple different definitions of that. What does that mean to you?
For us, we define work tech or the work revolution as people first, data driven, really big ideas that transform how we work today. So I'll break down that definition. The people first is important because at the end of the day, it's customers or employees that have to have, this dramatic improvement in terms of how the work is impacting them for us to get excited about it. And the second is data driven. I've done 125 deals over the last decade. And when I look to see which companies are doing well, typically there's some kind of proprietary data that creates additional value. So that's something that we look for as well. And then the third is big. We want to invest in companies that are going after really big markets that touch sometimes number of industries versus something that would be considered more niche. Okay, so that's our definition. People first, data driven, really big. And then we look at 3 areas within work tech. So the first is the transformative workflows. This is enterprise software. It can be horizontal, like a customer support platform, or it can be vertical. We did a deal out of our angel group in the vet industry. So antiquated, veterinary industry, obviously lots of ways to impact and enhance the future of work. And then the second is infrastructure for the freelance economy. We're very bullish that this area of our economy is going to continue just to blossom and get bigger. And then the third is HR tech, hiring, training, and employee engagement and retention.
Got it. Okay. No, you know what? I love that because you defined it very specifically in like concepts that I can understand, very like concrete the ways you define that. Sometimes you hear like the work revolution or just anytime really just the word revolution. I'm like, but what does that mean in reality? So I think you did a really good job being concrete with that. But you mentioned one thing that I want to ask about, which is, investing in companies with like a big TAM or, total addressable market where just big ideas, big concepts, big markets. So can you talk a little bit about, the power law or just, I guess, as a GP, as a fund manager, what you're looking for, from the financial point of view? Like, obviously you're investing with founders that you believe in, founders you like, but just the economics of a VC fund, it seems to me like there's, quite a bit of pressure, right? Like you have expense, like what you do is expensive. Like you have to have a team, you have to do due diligence, you have to source deals, you have to raise capital and all this stuff. And then also just the attrition or failure rate of startups is obviously very, very high. So I think, with private equity or private real estate, people are looking at like, oh, a 3x return in that, deal. That's great, but in venture capital, it's like, no, we need the winners to do way better than that. So can you talk a little bit about, how you look at that? Like how many, percentage wise, how many of your portfolio companies do you need to make it? And if they make it, how big do they need to make it?
Mhm. Yeah. So for those who aren't as familiar with VC, what we as GPs are trying to do is get a 5x net return on our funds. That would put us in about the top 10%. A 3x net return puts us in the top 25%. So that's kind of baseline. And a 3x net return on an early stage fund, so that would be pre-seed and seed stage, also probably Series A, that is commensurate with about a 20 to 40% IRR. So we are beating the 10 to 12% IRR in the stock market if we hit that 3x. Anything less than that, we start to get into, we're about equal with the stock market. And then obviously we're not liquid, so we're not as good of an investment. Therefore, we really have to swing for the fences when we invest. Of the 30 companies in my portfolio, I need to make sure that somewhere between 1 and 3 are going to be, hundreds of X return. And what that does is it helps me as a fund manager to make sure that I get that 5X return for my LPs. And in order to make sure that that's happening, I have to, one, be a good picker, and two, be very clear with my thesis around what I think has the potential to get there. That's why big is part of this. It's one of the things that I've really learned over time. I also look for capital efficient founders. So can they get there without having to spend a ton of money? I've been involved in deals where they didn't have to raise very much money after we invested at the early stage. And even though at the seed stage, my organization owned very small piece of that company, that one deal can still 5X the fund. That's really what I'm looking for. And hopefully I get a number of those, so it's even higher than 5X.
Got it. No, so that's the power law distribution though. And then in that, if there's 30 funds and one of them 5X, or 30 portfolio companies rather, and one of them, in and of itself, 5X is the return implied in that, there might be 10 or 20 portfolio companies that don't make it. And that just kind of comes with the territory, with venture cap. Like in real estate, it's like I need every deal to come back at least a single, and then I want some doubles and triples. I'm not even really shooting for a home run with the real estate deal, so it's a little bit of a different mindset, right?
Yeah, Fund One had 27 companies. We've shut down or exited for about a 1X, about 6 companies so far. And then there are 8 that are doing very well, and then there's a handful in the middle that it's still uncertain. I believe, based on where everything is trending, we are likely to have 3 or 4 that are superstars, so very big returns. There's going to be probably 4 to 6 that are good returns, and I'll call that 3 to 10X or 3 to 20X for those deals. And then the rest are going to be zeros or up to ones, which, those are the losers in the portfolio. And we expect, to Andy's point, at least half of our companies are going to be in that bucket.
Gale, I'm just talking to you. I'm a little bit jealous. I mean, I love this. I love this world of startups. Like, it's just, even the concept of you can invest in a company that's going to 20X, 50X, 100X your capital. It's like, on the one hand, it kind of makes my, my stomach, it makes me clench a little bit, like, oh, that's a lot of risk. But man, when one of those companies hits it big or does a big liquidity event, that's got to feel good, right? That's got to feel like you did something truly amazing.
Yeah, I mean, at this point, I've invested in 3 unicorns, 2 of them with Irish Angels and 1 with Vitalize, and there are more that are coming, which is the cool part. And the scary part, it can take 5 to 10 years to really understand how good of an investor you are. So you have to be really disciplined, which, to your point, it is really scary. And I have no idea if a company is going to make it or not. I have to make an educated guess. And a lot of it's based on intuition at the early stage, because there's not a lot of data yet.
So what do you mean by discipline then? Does that mean, you sort of named your criteria. So does
Mhm.
that mean like, oh, I really like this founder, I really like this or that, but the TAM, total addressable market, is too small. So I have
Yep.
to pass. Is like that what you mean by discipline, or is there something else?
Yes. So we have a rubric that we're looking for. Does it fit into one of those three areas within work tech that I mentioned earlier?
Mhm.
Is the stage correct? So are they raising the right amount of money, and do they have the valuation? So are the economics of the deal commensurate with what we're looking for? I think that I can underwrite this to 100x return. I'm looking at all of those things. So we do diligence to understand what do we really believe is the risk profile and the reward profile of this opportunity. And a lot of it has to do with the founder. Can they execute? And can they execute fast? And do they have a product that is very good already? It has to be an intuitive user interface. I can't tell you how many I see that just the product is terrible. And at this point in startup land history, like we just can't invest in that.
Yep. Understood. So I'm thinking, okay, if you're looking to underwrite for a 100x exit someday, and then I'm thinking, well, what's a typical valuation? I don't know, 2 or 3 million or 5 million. It sounds like you're dealing with more early stage companies.
Ours are typically at the seed stage 10 to 20 post, 20 million
Oh,
post.
okay. So then that
Pre-seed is like 5-ish million post.
got it. So then that's basically like you're looking to underwrite $1 billion valuation, like a company that can IPO, essentially. Is
Yeah.
that
Yep.
okay?
If I hit at least one of those in the fund, then we're gonna have good fund.
Okay. Now I'm gonna ask a dumb question, so try not to judge me, Gail. And I'm gonna hide behind Jimmy on this one because he was asking me. So both of us are angel investors. I was actually in Hyde Park Angels back in the day when I lived in Chicago. That was fun. I had a great experience with there. I did several investments there. Um, Jimmy and I are both limited partners in a VC fund, and we were talking about VC and angel, and he was like, "Wait, which one is the seed round? Is that the angel round or is that VC?" I'm like, "I'm pretty sure angel would be pre-seed, and then you'd have seed round would be early stage venture capital, and then you'd have Series A. Is that am I right? Can you just let's just pretend I know nothing. Could you just define pre-seed, seed, Series A, all that for all of us? Because now I've just confused myself even just now trying
Okay,
to.
I'm gonna answer for software, which is what I invest in. That's business to business software. The way that I think about the stages is based on traction that the founder has achieved. Pre-seed is typically either pre-product or post-product pre-revenue. So very, very early stages. When a company comes to us and they're raising pre-seed capital, it tends to be about $1 million round. And a 5 million post is very typical. So they're selling 20% of their company at this pre-seed, and they're using that capital to finalize the product and to get early revenue traction. Then when they start to get that, I got it ready, it's a good product, and I'm starting to talk with pilot customers, they're ready to raise their seed round. And a seed round tends to be somewhere between 2 million and 5 million. Valuations, let's say 8 post to 20 post. I've seen revenues at seed stage anywhere from 0 all the way up to 1 million. I tend to see about 250K is what we look for as a hurdle point that is typically good. It means they've got a number of clients and they're really starting to figure out what their clients want in the
Mhm.
product. And so from there, a founder is really trying to get somewhere between 1 and 2 million of annual recurring revenue for that software product to hit the Series A. And this is what a lot of VCs will call early product market fit. So
Mhm.
as you accelerate into that, close to $2 million of annual recurring revenue, the later stage VCs get a little bit more certainty that you've hit something that is a true pain point for your customers. And then into Series B, you're trying to hit 5 million of ARR. And each time you do this, you have somewhere between, let's call it 6 months on the very fast side, all the way up to 2 years to hit those milestones. So when a founder raises their round, they really want to try to raise enough to ensure that they hit that milestone of getting to, the next stage. Otherwise, they're going to be stuck in no person's land. And that's where, we just can't invest in those companies.
Understood. Yeah. And I'm thinking, what you just told me, that kind of tracks to like Alex Hormozy. He talks about 3 million as a threshold where you have product market fit, but he's talking about a lot more content based businesses, or e-businesses, e-commerce, that kind of stuff. Whereas I think software has more enterprise value. It's going to have a much higher multiple tagged, I think, to a software business. So that kind of makes sense. So then, okay, like a company raising at 4 million pre-money valuation, they're raising $1 million. That would be pre-seed and that would be angel. Is that right?
Yeah, and the interesting thing about angels can really participate anywhere as long as they have access. So we just led a seed stage deal. It was a $4 million round. And those founders took money from some angels. There were 5 or so VCs involved, plus a few angels. So I would say angel comes in a lot at pre-seed, but it also comes in quite a lot at seed, and sometimes even later than that. But most of it is pre-seed and seed.
So why would an angel investor come in at seed? Is that because they have co-investment rights or whatever? Or is that just because the VC fund doesn't want to bite off that whole capital raise? Like, why would they allow, I guess, an angel to invest in a seed round?
Yeah, so a founder that has a lot of options is looking for the set of investors around the table that are going to add the right value.
Mm-hmm.
This deal that I'm talking about is a great example where, I'm bringing future work experience to the table. Another investor's bringing fintech. Another investor's bringing go-to-market. Another investor's bringing customer
I
interest.
see.
So like all of us are coming to the table with our own specialty and our own value add. And I want, if I'm the founder, and this is what I counsel our founders on, make sure that you, one, like everybody that's investing in you, but two, they're bringing something that is unique to the table where you're going to get value from it. And sometimes angels who cut even small checks can be very strategic. Maybe they've been a head of product in the same industry and you need that expertise. If you give them $5,000 or $10,000 allocation in your seed round, with the understanding that they're going to help you, sometimes that is the right thing for a founder to do.
Understood. And so if I'm a GP, leading around in that case, I might rather invest, instead of investing 4 million the whole round, might rather put 3 million in and let that founder fill up that other million with strategic investors who are actually going to basically help execute or help find, give them advice or connections or whatever that will help them get traction. Okay. That makes a lot of sense. And I want to talk about angel investing more, but before even getting to that, I want to talk about the capital base of your fund and just VC in general. It's interesting because I mean, in theory, like I guess like in a textbook, this is all kind of under the umbrella of private equity, right? That you have. I mean, it's funny how much I talk about this issue with guests. I'm host of the Alternative Investment Podcast. If you Google or go into iTunes, search alternative investments, we pop up number 1. And I'm like, I still don't totally understand this. What is all this called? Like people ask me, what is an alternative investment? And I'm kind of like, well, it depends on who you ask. I can give you like 7 different definitions, but private equity in theory encompasses private real estate, private equity, venture capital, maybe, angel investing, but there's such different capital bases for those because like in private real estate, so many funds now are taking on investors with like 100K checks, right? So LPs is like the minimum is 100K. There's so many private funds now that take on LPs to invest 100K. Whereas in venture capital, my experience, the minimums tend to be a lot higher. But then the other aspect is with private real estate, I can probably, like if I invest in 1 or 2 or maybe 3 diversified funds, I can feel like, well, that's pretty good diversification. There's always a chance that, one GP is going to be a fraudster or something, but it's real estate, it's asset backed, whereas in venture capital, it feels like, well, geez, I probably need to make more than 1 or 2 VC investments as an LP to feel like I have a diversified allocation to that asset class. So due to the higher typical minimums, I think, as well as that diversification thing, I feel like it's like you almost need to be institutional or family office to really allocate to VC. Is that your experience, Gale?
Yeah, unfortunately, there's a rule that the SEC enacted back in the 40s, I believe, that requires GPs who are raising more than $10 million to do that from 99 or fewer limited partners.
Mm-hmm.
And actually, the reason they did this, interestingly enough, is because back in the day when everything was paper-based, they just wanted to put a limit so that the folks pushing the paper weren't going to be overloaded. So I'm part of some lobbying efforts right now. We're trying to increase that number because obviously everything's automated today, and it's really a silly, antiquated rule. But what it does is it pushes a lot of people out of this asset class. Mm-hmm. For me, let's say I were raising a fund today, and my fund target is $50 million. I only have 99 spots. So I have to make sure I'm getting, $500K, $1 million, more than $1 million from a good number of my LPs so that I can take a few smaller checks and still get to my $50 million target with that limit.
Now, does every VC fund have, because there's private equity funds, obviously, that don't have this legal restriction, that have hundreds of accredited investors. So is this specific to how the fund is legally, or maybe I need to talk to your lawyer. I don't know, but.
Well, there's a QP, so a qualified purchaser fund can have up to 2,000. So a lot of private equity funds would fall under that designation. If I'm taking money from accredited investors, that means they have $1 million in net worth outside of their primary residence, but they don't have the $5 million level, then I'm in that I'm in the SEC reg where I can only take from 99 investors.
So if you have the lower threshold of accredited investor, you can actually only take on fewer investors. But if you set your threshold higher to qualified purchaser, then you could take on more investors. Is that?
Yes.
That right?
Yes, it does make sense. But yes, we love qualified purchasers. We love accredited investors. I am a founder at heart, and I'm trying to innovate on this. If we can't get Washington to fix this regulation, one of the things that I've recognized is, if you create an LLC, so this is a special purpose vehicle, mm-hmm. and you have at least 3 VC funds involved in it, that means you can take 249 people to invest within this entity. They just have to be accredited. And you don't have to pass through count those people if each of those 3 managers is taking less than 40%. So we all take a third, which is less than the 40% threshold set by the SEC. Therefore, it's on our cap table as 1 LP. So I have a couple of those entities being tested right now. And what it does is it allows a bunch of people to write checks into VC funds for the very first time. And it's interesting because the way we set it up, one has a $20,000 minimum and the other has a $40,000 minimum. Both of them are $10,000 a year. The thinking being, everyone who's accredited is making $200K at least of salary per year. And so this is a small percentage. Most accredited individuals can afford $10,000 a year. And we want to open up funds to more people so that they can do it at a threshold that's safe for them, especially as early as possible in their careers, so that later when they have more capital, when they have more net worth, they might say, you know what, I've really learned a lot about investing in these various funds. I'm ready to be a bigger LP.
That's a really interesting idea, because that not only that makes it more accessible, but it's a diversified bundle, right? Because an LP, if you're going, okay, if a fund minimum is 500K and I feel like I need to invest in at least 3 funds to be diversified, now all of a sudden I have 1.5 million allocated to VC, and maybe I want 10% of my portfolio to be allocated to VC. So that means I need a $15 million portfolio to allocate to VC, which is great, right? Obviously, the definition of accredited investor is way below 15 million, even qualified purchaser is. So, that sounds like that could be a really good solution for people.
Yeah, when I first started doing deals 10 years ago, I thought that the right answer was for people to build their own angel portfolios, but it actually takes a lot of time and energy. And you have to
Gail,
have,
I got to stop you there. Like that's me. I'm like I did it and I loved it. Like I did it when before I was a dad, and then maybe when we had our first. I actually loved it, but it was almost more. It wasn't even just a financial thing. It was just being around founders. But and then I was like on an advisory board of one of the startups, and that was fun. But I just like don't have time for that anymore. I don't know. And if you're writing a check for like 25K or 50K, and how many of those are you going to write? You're supposed to due diligence all of those. It's just like you don't have the time, right?
yeah, I mean, I personally have 45 direct angel deals, but I started doing small checks into funds. So I've written 25K checks into small funds 6 times now, and I will do much more of that going forward. Um, in addition to what I'm doing, so I'm a mid-sized fund. You're trying to find $50 million, as are the others that I'm working with. But there are some funds out there that are $10 million funds that will take $25,000 commitments from LPs. And so for anybody out there that is interested in starting to write that size check, I'm happy if they DM me on Twitter or LinkedIn to give them some names of funds where they would be able to invest at that level.
Yeah. And for our audience, I have to recommend Gail knows, it seems like she knows almost everybody in this whole space because she's been operating it for so long. So
it is a long time.
she probably gets like 50, 100 DMs a day. So it's very generous of you to even offer that. I want to shift a little to talking about angel investing now. So, talked about venture capital. Angel is just more accessible. I mean, the thing I like about it, and maybe I don't like about it, but that I like about it is that it's more time intensive in a way, but like it's fun. Like to me, it's something I want to do maybe when I'm retired, just not even for financial returns. Like it's just I love startups, I love founders. But I want to talk about your specific angel investment platform. So this is the Vitalize Angels. And I know even that there are some details here, something that you guys are doing that's really unique to make it more accessible to even non-accredited investors. Is that right?
Yes.
Tell us more.
Yeah. So once again, I've been in the industry for 10 years. And for those of you who like data, I'll share a stat with you, which is alarming. The percentage of dollars going to underrepresented founders today is lower than it was when I started in 2012. And the reason that's happening, if I take a step back, and this is a really important point for everybody to understand, the founders are getting dollars from GPs. So these are VCs. So the VCs are determining which kinds of founders are getting funded. And there is a certain recipe that a lot of VCs, especially the big VCs, are looking for, and that's limited in terms of who is able to access that. Well, it's really the limited partners who dictate where their money goes to the GPs. And many of the limited partners are institutions, endowments, foundations, pensions. These are really large pools of capital. And so they have to write large checks. And these large checks go to the big funds, and the big funds are investing in the same people. So you see that it's this virtuous cycle that keeps happening, and it needs to be broken. And when I take a step back and think about the business model and is there something we can do to innovate? I just told you about the fund model that where we're offering people the ability to invest a low amount. On the angel investing side, you have a few things that you have to do to remove hurdles. One is to allow everybody to do it, so you don't have to be accredited. And the second is to reduce the minimum to invest. So where a lot of angel groups or syndicates require $5, $10, or even $25,000 per deal, our minimum is 1,000, with the thinking being, let's say you're not accredited, but you make $100,000 a year and you have $5,000 that you want to allocate. You can do 5 deals at $1,000 per year on our platform. And in 5 years, you have yourself a portfolio of 25 deals. And the most important thing is you actually got your checkbook out and not wired your money, and you've done it enough so that you can feel the pain when something goes wrong, and you can feel the excitement when something goes well, and you're seeing the reporting and you're learning and you're getting comfortable with the asset class. It's all about letting more people sit at the table.
That is so interesting. I'm thinking even as an investor, as an LP, you're like getting your reps in, right? It's like, it's better. I mean, I don't know about financially, but if you're trying to improve your own skill as an investor, it's better to do more deals, to say no to more deals, to say yes to more deals, to experience more of the ups and the downs, like you said. Like why as a GP you have so many reps in, and I think that's the reason a lot of people trust you, right? And that's your credibility, because you've done multiple funds, you've done all these angel investments. Like at this point, you've probably seen it all, right? But to do that as an LP, you'd have to have a pretty big checkbook, right? Whereas with this angel platform, it allows you to kind of succeed small, fail small, just get started with a relatively small amount of money.
Yeah, it's a really interesting model. We have 450 people in the group. About half are accredited and half are not accredited. And we're seeing checks being written anywhere from $1,000 to $10,000 per deal. So, some people are allocating a little bit more than the $1,000 minimum, which is great. And we're seeing a lot of interesting things like colleagues are joining together, or we have some parents who are bringing their college or just after college aged kids in and doing something as a family. And they can do that because the minimums are low. So it's this really cool model, which it opens up the opportunity for a lot more, diversification really sitting at that table.
I love that. Just the idea of community. Yeah. Like I said, that was my kind of experience with angel investing. It wasn't like you almost think like, who was the angel investor with Google or Microsoft or whatever? They made $1 million X, but that wasn't my experience at all. It was more like people just having fun and kind of networking and building community and being supportive. So I absolutely love the idea of giving more people a seat at the table. Yeah. So does this fit into your VC fund picture? Like, are these pre-seed companies that might become portfolio companies later?
Exactly. Yes. So if a company comes to us, they're a strike zone fit for our criteria, but they're pre-seed, so they're a little early for our seed stage fund. We ask the founder, would you like to pitch our angel network? And we explain that it's crowdfunding because there are some red tape factors that the founder has to consider there. We partner with BeFunder. So we have all of that, good processes set up. Here's what it looks like. Do you want to pitch? If they say yes, then our team will do the due diligence. We'll put it in front of our 450 investors. If we get collectively 50,000 K plus of interest, we'll close that deal. When we close that deal, the founder gets the cash, and they also sign a side letter with us, which will allow our fund to come into the next round, if that makes sense. We're actually the deal that I mentioned earlier that we're leading right now was a Vitalize Angels company last year. So we got finally our first one where it came full circle. The founders knocked it out of the ballpark. We worked with them for a year. We effectively bought an option for our fund investors.
That's so awesome. Okay. Well, now I have to ask, loaded question. I do have a dog in the fight. So if it's on WeFunder, it's crowdfunded. If I join the club and I invest in 20 deals, do I get 20 K1s or 1 K1? Or tell me about my K1 situation here.
Well, here's why I love what we're doing. So there's no fee and no carry for you, the investor. And there's no K1 unless there's a distribution. And when there is, it'll be one with all of your distributions collectively together, which is way better than anything I've seen. So once we get past the part of it's harder for the founder, which means we have to work really hard as the VC team, bring the founders, and we have to sell them on the process. Once we get there, everything after that is way better for our investors.
It's just really amazing, all this stuff that you've done, Gale. I mean, the thesis of your fund, I love that, and just your track record. But just like in all these areas of the ecosystem, I feel like you are removing friction and just improving access. Do you feel like you have, are there other people in VC and Angel really working together to do this? Or are you going against the grain, I guess, with
there
your
are
mindset?
A lot of people that care about this. I think I tend to push the envelope a little bit on model. I'm working on one that's even bigger right now. And if I can figure that out, then it will make a much bigger impact than what I've been able to do so far, which will be awesome. But I see little girls, Andy, I see little boys, and when they're sitting in our seats in 25, 35 years, unless we make drastic changes today, those girls are going to have so much of a harder time than the boys will, because nothing will have changed from today. And I say that after 10 years of experience in this industry. And, I've thought about quitting many, many times, because I have to be so much better than the guys who have the same experience as I do in order to make it in this world. And therefore, I want to use my talents to completely, blow it up and see how we can make things happen, so that when those little girls and little boys get here, it's more of an equal playing field.
So, I appreciate you sharing that, your experience as an emerging manager. And just, I mean, I feel like VC is so almost like a daunting, kind of a daunting, field or industry to break into as a GP. It's, like I said, it's amazing what you've done. Do you feel like as an emerging manager, I think I can use that term, a smaller fund, what you're doing
emerging. You're emerging through fund 3, technically.
Okay. Have there been other people who've kind of given you a helping hand, and with mentoring or anything like that? Or have you had to kind of fight your way to where you are?
The group of people that I owe everything to are the angels and the GP, or the angels and the limited partners who believed in me from the beginning. So these are the wonderful people I met through Irish Angels, and then the fund 1 for Vitalize investors. And many of them are reinvesting in fund 2. And, I've told them I will always, always, always let any of you invest in my future funds for whatever you can invest. Because I really believe in giving back to them. They gave me the start here, and without them doing that, there's no way that I would have been able to get off the ground. And the other thing I will mention is the set of other GPs that I have met in the industry is also truly amazing. Being in this seat, and this very well, it's the same as a CEO seat. It's very lonely. You have to figure everything out on your own. You have to do all aspects of the business, and being able to go to the hundreds of other GPs that I know is a lifesaver.
Wow. I love that. And Gale, I just want to thank you for what you do, because not only, everything you're doing, removing friction and just being creative and trying to expand access, you also, just back to the beginning, you're sharing all this stuff online, on LinkedIn and on Twitter and everything. And I feel like that's already helping the next generation. I mean, I know you're technically an emerging manager, but I also kind of feel like you've made it, I mean, you definitely have. But you know what I mean?
I don't feel like that, Andy.
Well, you have. I hereby officially declare that you have made it. And I feel like just sharing the process, the ups and downs, and all of that, that's helping influence the next generation, the emerging managers of even 5 years from now. So I really appreciate just everything that you share online, and also, the cool opportunities that you've talked about today, especially the angel investing group. I love that. We may have some potential LPs for the venture capital fund listening. So that being said, where can our audience go to learn more about Vitalize Venture Capital?
Sure. We have a website, vitalize.vc, or you can send me a direct message on LinkedIn at Gale Wilkinson, or on Twitter. My handle is at GaleForceVC.
And I'll be sure to link to all that stuff in the show notes so you can click it easily. Gale, thanks again for joining the show today.
Thanks, Andy.